What's up, traders? Anthony Crudele here. When should you trade an event contract? First off, event contracts, in my opinion, are not something that really needed to be looked at and traded every single day. They are a situational product. Now, depending on your strategy, it's really going to come down to, well, what situations make the most sense to trade an event contract. In today's video, I want to go over one scenario that we could really all relate to, and that's the runaway one-way market, that trend day that, look, you see that trend day is happening. You didn't catch it right on the open, and the market's going up or down pretty much in a straight line, or market's been trending like that for days or even weeks. And you as a trader can't find a way to participate in it because the stop's too wide. You feel the market's overbought or oversold based on your indicators, and you're like, you know what, it looks like it's going to keep going, but there's really no trade for me. That's when I think an event contract makes a lot of sense. In the chart in front of us, I have up crude oil. Now, crude oil lately has just been in a runaway one-way type tape. You can go back and look what crude oil has done, roughly $77 to $89 over the last couple of weeks. Throughout this time, I've been bullish crude oil, trading crude oil intraday. And then when this top Bollinger Band started to go straight up, and then all of a sudden started to take out this previous peaks, and it looks like volatility is really expanding, that's when it's telling me, okay, this thing, even though it's already run quite a bit, and I'm no longer long the crude oil market, how far could it go? Could it go to 90, 91, 92? Who knows? Volatility is expanding. When you look at this with the Bollinger Bands, you can see that anytime the market's going in one direction and the mouth of the Bollinger Band is open, that is a very strong signal to me as a trader that because we're going in one direction and volatility is expanding with the mouth of that Bollinger Band, this move can have real legs. Well, like I said, I've been bullish. I've been in and out of crude oil. I've been long it, did okay, made a little bit of money. And now I look at it and go, how could I be long here? Where am I going to put my stop? Even if it broke a buck, intraday, the trend is still massively to the upside. So it's very difficult to manage risk, even though the trend might continue for who knows how long. We just don't know. So this look, when I see this on a daily, and you can see that a market's been trending and it has a lot of trend days, makes a lot of sense for event contracts. Let's go and take a look at the Tradovate app now. Here we are, the Tradovate app. I already have the crude oil market open in here because that's what I've been looking at. And what's interesting about event contracts is that it only comes down to the close. That's it. At the end of the day, you either make zero if it closes above your price, or you make $20 minus whatever you paid for the event contract at the end of the day. And so what I like about this is that all it has to do is close one tick in the money. That's it. And so if I look at the crude oil strikes and say, look, I think it's going to close just above $89 today, I could pay $10.75, $10.50, whatever it's trading right now. You can see it's trading, it's moving around. If I pay that, that's all I could risk. And this is actual dollars. These are not ticks. So if you wanted to buy one, it would cost you $10.50, right? If you wanted to buy 10, it would be that number times 10. So just over $100, $105. So understand that with this product, it's good for this type of scenario because you just basically bought your risk. You don't have to manage a stop. You don't have to look at the chart and say, you know what, I hope it holds above X price because I'm going to work my stop there, and the market goes down there, dings you, gets you out, and then it rallies. And we all know that that can happen a lot of times in trend days. So all you have to look for is an area where you think the market can hold throughout the day, close above it. And I like to do these trades towards the close. I wouldn't recommend doing them early in the morning. Crude oil closes at 2:30 Eastern. I like to start looking at these strikes around 1 Eastern. Where are we relative? Crude oil a lot of times doesn't have a ton of volatility late in the day. So if it's steadily holding above one of these strikes, that's when I like to step in and purchase the event contracts. You can see right now they're getting just below $89. You can move it down to $88.50. Will it close above $88.50? Well, that price is $15. I would also say I would recommend never really to pay in my opinion, more than maybe $11, $12 for an event contract. So I would wait for this to come down to 88.50 and then I would buy it. You could also work an order there because I think the risk reward doesn't make a lot of sense to pay $15 for an event contract and then have it close at 20 and I only make $5 for putting up 15. So I really like the sweet spot for me is between 7 and like 11 and $12 is like the most I'll pay. And so you just wait for those areas to come in. And what I like about it, once again, is I'm just paying for the trade. I bought the risk. I paid for it. It's over. It closes above it. Great. I get paid. If it doesn't, I bought the trade. I lost. But this is a way to participate in that one-way trade. Now, there is a counter to this as well. Another way that I like to use event contracts, fading a market that's in a one-way trade. We all know that there's been days where we've been just grinded to a pulp, getting short a trend day up, and you're just sitting there, just keep getting death by 1,000 cuts, right? Ticked in, ticked out. You're paying up to get in, or you're paying down to get short, and then you're getting ticked out every time the market keeps grinding higher. And then eventually, maybe later in the day, you see a little bit of a sell-off. You could look at this from that window as well, that perspective. If you think today that the crude oil market can pull back and close below 88.50, well, this is a cheap play. You could pay $5 and you would make 400% return, 4 times your money. If you bought one at 5 and it closes below 88.50, you make 20, net $15, right? And so from my experience, this is a much better way to step in and fight a trend because I'm putting out little risk for good reward. I don't have to just sit there and manage a short against the trend, right? You can go in, and even if you thought they would get below $88 and close below it, look over here. Those are $1.75. That's not really that far of a move. If you really look at it, $88.85 is where we're trading right now. $88. Who knows? I mean, it's unlikely. That's why it's priced so little. But if you want to make that type of trade, it's $1.75 to get paid 20. I like that. You could buy 10 of these. It costs you $17.50. And if you're right, you're going to make a couple $100. So I look at that in these scenarios and say, these are times when I would like to use event contracts.